Welcome to This Explainer. Today, we're diving straight into the massive storm that is currently hitting the $1.2 trillion home improvement market, and specifically, its absolute biggest player, the Home Depot. Whether you're an investor tracking retail trends or just fascinated by high-stakes corporate strategy, what's happening right now with this company is honestly a masterclass in navigating extreme business turbulence. Well, let's start with the catalyst. On August 12, 2026, Home Depot's stock suddenly dropped over 3% in a single day. You might be wondering, what triggered that? It was the shocking news that Chairman, President, and CEO Ted Decker was taking an immediate temporary medical leave of absence. Now, running a massive company is hard enough on a good day, but a sudden leadership vacuum like this, it creates serious shockwaves. Section 1. A sudden leadership shakeup. So the board had to move fast, and they appointed two incredibly seasoned veterans to split the day-to-day CEO duties. And notably, they're doing this without any extra compensation. First up, we've got CFO Richard McPhail managing the financial operations and the pro subsidiaries. Then Anne-Marie Campbell is taking over U.S. stores and operations. Her story is actually amazing. She started as a cashier there back in 1985. That is over 4 decades of unmatched retail experience stepping in. Meanwhile, lead independent director Greg Brenneman stepped up to serve as board chair. This move brilliantly highlights the board's main goal right now, projecting absolute stability to the market. When Brenneman points out their 20-year working relationship, he's sending a direct signal to Wall Street. The timing was absolutely crucial here. They literally had to show investors a steady, united front just days before their fiscal second quarter earnings report on August 18th. Moving on to Section 2. Unpacking the financials. At first glance, their first quarter of fiscal 2026 actually looked incredibly solid. Revenue hit a massive $41.8 billion, which beat analyst expectations. They also posted adjusted earnings of $3.43 per share, slightly edging out the consensus, and comparable sales returned to positive growth, rising 0.6%. So on the surface, the engine seems to be humming along perfectly. But if we look just beneath the surface, there's a really stark contradiction. Despite generating nearly 5% more revenue, their actual net earnings dropped from $3.4 billion down to $3.3 billion year-over-year. Think about that for a second. They are bringing in a lot more cash at the register, but they're keeping less of it in profit. The crucial takeaway here is that while Home Depot reaffirmed their full-year guidance for modest top-line growth, targeting around 2.5 to 4.5% in total sales, their profit margins are clearly under severe pressure. Wall Street was expecting Q2 earnings around $4.73 per share, but keeping those bottom-line numbers healthy is quickly becoming the central challenge for this new interim leadership team. Let's dive into Section 3, the frozen housing market. To understand that profit squeeze, we have to talk about the reality consumers are facing right now, and it's pretty tough. The entire home improvement industry heavily relies on housing turnover. Simply put, when people move, they renovate. But mortgage rates have stubbornly bounced back up to around 6.7%, partly driven by global factors like ongoing conflicts in the Middle East. Because of these rates, existing home sales plummeted by 8.4% in January alone. Folks just aren't packing up and moving. CFO Richard McPhail totally hit the nail on the head when he called this 3-year stagnation a frozen housing environment. When you combine high mortgage rates with rising fuel costs and layoffs, housing affordability is stretched to its absolute limit. Because of all this uncertainty, consumers are actively delaying large discretionary projects. We're talking big-ticket items, new flooring, lighting, millwork, lumber. And those just happen to be the exact categories that drive high-margin profits for Home Depot. Now, here's where it gets fascinating. We're actually seeing a massive shift in consumer behavior. Homeowners do have a ton of equity built up right now, but when they tap into it, the data shows those funds are increasingly going straight toward debt consolidation, not home improvements. People are using that cash to pay down credit cards, not to build a new deck. This fundamentally puts retail margins at serious risk if demand doesn't pivot. Which brings us to Section 4, pivoting to pro customers. Look at that number, $700 billion. That is the estimated total addressable market for professional customers. We're talking contractors, builders, tradespeople. Unlike your everyday DIY homeowner who might buy a single drill or a few cans of paint, these pros make large, recurring purchases. They are the absolute backbone of the industry, and Home Depot has decided that winning them over is the only way to survive this frozen housing market. So to capture a bigger slice of that massive $700 billion pie, they launched a sweeping internal restructuring. The centerpiece here is the new Office of Pro Acceleration, interestingly led by Richard McPhail himself. This office is designed to completely unite Home Depot Pro, HD Supply, and their recent SRS distribution acquisition. Alongside this, they're consolidating merchandising under Billy Bastek, unifying the customer experience under Jordan Braji, and merging their tech teams under Fran Bell. The ultimate goal? Create a totally frictionless, interconnected system for the professional contractor. This pro strategy totally transforms how we should view Home Depot as a business. It expands far beyond their 2,300-plus retail stores. Their network now includes over 1,280 SRS distribution locations. They aren't just waiting for contractors to walk down the aisles anymore. They are pushing direct-to-construction site deliveries, rolling out advanced project planning tools, and leveraging their massive army of over 470,000 associates to cater specifically to complex professional jobs. Finally, Section 5, the road ahead. So, what is Wall Street's current verdict? There's a clear sense of cautious optimism. Despite the recent stock drop down to around $343 after the CEO's medical leave announcement, the consensus rating remains a moderate buy. The average price target sits around $371, but what really stands out is Bank of America actually raising its price target from $374 all the way up to $412. They're making a significant bet that Home Depot's aggressive pro strategy is going to pay off big time. But hey, the pressure is absolutely on to hit their massive corporate projections by 2029, which includes reaching $187.2 billion in revenue and $17.3 billion in earnings. Home Depot must maintain an annual revenue growth rate of about 4%. And they have to do this straight through all the macroeconomic headwinds we've discussed today. No pressure, right? So I want to leave you with this final, provocative thought to take away from our explainer today. With a completely frozen housing market keeping everyday homeowners on the sidelines, can interim leaders Anne-Marie Campbell and Richard McPhail execute this incredibly aggressive, deeply complex pivot toward the professional contractor fast enough? Or will this perfect storm of absent leadership, high mortgage rates, and squeezed profits prove to be too much for even this retail giant to withstand? Thanks for learning with me today, and definitely keep your eyes on how this plays out in the months ahead.